So good morning, everybody. This is Gary Fuller, and this happens to be a lesson a little bit more, I would say, advanced, more of a story versus necessarily tapering of a chart. And it's a very important illustration of a chart that's not easy, but one in which that must be understood. And I will tell you what it is um, after we get this thing done. And so this is something that's really important, and it's something that is something we need to understand. So this is a stock that's going up and going up, and the easy movement is up. And one of the really nice things about this particular stock is that when the market retraces back down, we really don't have supply. So if we have called an average true range, and this market does this, and that's somewhat of a really a some type of sign of strength bar in the market action. Now, the thing about sign of strength bars is that they don't necessarily have to continue to mark up. They can retest lower and be bought. And the reason why that's important is because many times people think a sign of strength bar will automatically go up immediately. That's a breakup bar to go higher. But sometimes the market may not be ready. It could be just a probe that what goes on. And the reason I'm saying it is because when you get a sign of strength in a chart after a selling climax, that turns your trend to a wyckoff theme up, even though the market is not taking out a previous reactionary high. So the sign of strength or sign of weakness does change your trend to wyckoff doing, but it may do some back and filling. So we know that this market has some type of sign of strength, high volume, wide increase. So gaps don't exist to wyckoff. It's probably called average true range. So I take this and I draw that line across. That becomes my support area of the market. Okay, it may or may not mean nothing. Okay, in this case, it doesn't mean anything. But the fact of the matter is that that line is there as an overall story market. We come down here. This bar length here is about as wide as that bar length there. But look at the difference in volume that happens. It's about one half the volume. So that tells you that they're more aggressive buying versus selling. Well, this market's in an uptrend. That's great for us. Even if the volume is high, the buying volume is still higher than the selling volume. Even though that volume is high, we get to the point where the market still maintains its bullishness in the market. Okay? So that's something that's really important. If this was a very large bar, and this was a bar that it was occurring that had the market like this, and that volume was like above that volume, then we consider that stopping volume, and the market hit probably some type of change of behavior of markets. But in this particular case, we didn't have that. So since we didn't have that, the market just has gone down. That's what we call that long liquidation, not supply, long liquidation, and the market went down. Then this is very important. The market maintains the area that the market broke out from, and the volume doesn't increase. So the market's just biding its time. That volume that goes sideways there's no leadership, right? The funds are getting involved, the CN's not being involved, there's nothing really there. Then an important part happens that we have this spring, okay? Now, I consider this a springboard, okay? Or you can call it a terminal spring, but you don't know until the market makes new highs. But whatever you want to call it, it's a spring. It's a spring with the sign of strength in the background. You must take that trade. It's a very low risk, high reward trade because that's stopping action. Okay, so you mentioned earlier about maximizing your gain when you're right. This is a situation where you want to put on 2 units. Okay, because your risk reward, your stop is here. Okay, if this market's in the ready position, and with a spring like that, it's in the ready position, right hand side, ready position, the market should go up immediately or at least react well. We get a great reaction. Boom. Once this happens here, okay, you get that little average range, Your stop really could be under this little high here, eyeball test. So you're maximizing your risk, okay? If you want to get out of one contract because you're kind of nervous and you see this kind of resistance here, okay, you can. I wouldn't because you have cost built. But if you want to get out of one contract, I have no problem with that just because you want to put money in your pocket, right? We go up, we continue to go up. Now we hit a good volume because this bar here, buying overcame any selling. Buying here came overselling, selling. So that means that's really a bullish sign, right? And all of a sudden, now you're getting more upside value on a retest after a spring, perfect reaction. I am not concerned at all. Okay. The only thing I'm concerned with is the market goes sideways for a while, and I don't get the equity as quickly as I want to get. But from a standpoint of direction, you're golden. Okay. Now we talked about this a little bit yesterday with reverse trend lines. If I take this reverse trend line and I take this reactionary high here before we dipped, I want to draw that line like that. Okay. If it doesn't fit, it's fine. I want to draw that like that. It's a 40. It's a the hell happened? It's a 45-degree angle. Okay, it's a 45-degree angle. Okay, and that's going to be our objective to where we think the market can go to. Okay. Now, if I draw the line across the high, you'll see some interesting. You'll see the market here at the apex, at the axis level. And you see the market correct from there. So a 45-degree angle here against the reactionary high. If you got out here, okay, and said, okay, I want to call it a day, okay, I have no problem with that as long as you're ready to buy the market. Now, since we have strength in the background, you now have this line, this bar here, as my support. I'll draw that across. Here you have buying tails. They go down, up, down, and up, down, and up. That is accumulation. That's not absorption, that's accumulation. You're accumulating stock or commodity at the support level, keeping the integrity of the action involved. Very important. When that is all said and done, and it actually is a little spring, right? It's a little spring. Okay? Look at the volume that comes back into the markets. Boom. Buying overcomes selling. Okay? Now, in this case, all of a sudden, that's good. All of a sudden, we get a retest. But here's the difference. Look at the volume here. Remember, at every retest, the volume was lighter, the red was lighter, the sun was lighter. In this case, it triggered off a lot of volume. Here's what's key. This market did not make a new high. Okay, here's the high here, right? This is very important. That market did not make a new high, did it? So the fund and the specs did not buy new highs, did it? Because they usually buy breakouts. So when they bought the market, anticipating a breakout, the market was not able to make a new high. If your funds and specs are buying it and the market's not making a new high, who's selling it to them? The composite operator. Now, from a novice standpoint or rookie standpoint, you would think that it's high-end close that's bullish. But because of the volume happening, it's not really an upside probe because we didn't go higher, did we? But it's a market that's called what I call stuffing. They're stuffing, they're keeping the market integrity bearish. So I call that kind of a stuffing bar, even though it's not the best example I can give you, but that's effectively what it does. Now I want to see, okay, if that's selling by the CM against funds, I want to know if the market goes back higher, if the volume increases. What does the volume do? It decreases. So they kind of killed demand here. Any demand that came was sold. They kind of killed demand. The funds and specs are not buying it. Well, if they're not buying it, the CM's not buying new highs. The path of resistance, even though the trend is up, and probably remain up until you get a supply, which is not supply. The market is going to correct in this phase. Doesn't make the market bearish, doesn't give you the right to sell the market short, but it tells you, haha, this retest is not of good quality. Even though it looks like absorption, the absorption changes your idea because of this bar here. Okay? If it makes new highs and close here, I would say that's a probe to go higher. It probably still is a probe to go higher. Okay? But since it's not the new highs, it did not get the funds involved. There's your break. Now, the question is that a supply break or is that a long liquidation break? Well, it looks like long liquidation to me, doesn't it? Just the current chart. This was your quiz chart from today's newsletter. This is daily Coca Cola. Okay? Coca Cola. Okay. Why did I pick up daily Coca Cola? Because you're going into the holiday season, Christmas. This stock tends to do well, obviously, because people buy more cocoa for parties. So in summertime and holidays, they tend to go higher. They anticipated that a month in advance, didn't they? Boom. So this is why you don't want to necessarily buck seasonal stock. The market then got to the point, it's okay, we sold X amount of dollars pre-order wise to stores. We kind of got that maximum value of that stock because we anticipated that earnings may be 10% above last year or whatever. And now the market's correcting, even though we not got to the holiday first. Does that make sense? So it's long liquidation to the markets. Long liquidation to the markets that occurs, but it's going to wipe out some longs. Our logical place to be buy a long is what's either here, but it's important this reverse absorption. This is your LPS area, right? Halfway back of the range. LPS area of the market. Remember now, the large volume bar is larger than the side of strength bar. So you got to be careful now of when you want to buy the market. You want to buy the market with a short downward thrust or some type of spring activity. Okay? Selling tends to be greater than buying because of the fear factor in stocks. But that is something that we got to be very, very conscientious of to the markets. The low end close, low end close, low end close, and this area is of poor quality. That means the market should attack lower to spring. Okay? Buying tends to be higher in stock than it does in commodities because people own stocks with IRA and things of that nature. So that's a good illustration of that explanation of that stock. Any questions? Good. Okay.